Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Louis, and I'll be guiding you through the latest news and trends that could impact your portfolio. Today, we're going to talk about a story that's been making waves in the tech industry, the future of AI and its potential impact on the stock market. Specifically, we're going to look at NVIDIA, a company that's been at the forefront of the AI revolution. With their graphics processing units, or GPUs, being used in everything from gaming computers to data centers, NVIDIA has become a key player in the development of artificial intelligence. Recently, analysts have been weighing in on the company's prospects, with some predicting big things for the future. Truist analyst William Stein has maintained his buy rating on NVIDIA, citing the company's dominance in the AI market and its potential for mid-50% EPS growth. Other analysts, such as those at Wedbush, have also expressed optimism about the company's prospects, noting that hyperscale capital expenditure forecasts for 2026 have already exceeded prior expectations, but not everyone is convinced. Some investors are worried about the potential for a slowdown in AI-related spending, which could have a significant impact on NVIDIA's bottom line. As Stein noted, some investors are even talking about the collapse of everything AI-related, including capital expenditure and AI infrastructure supplier revenue. So, what can we expect from NVIDIA's upcoming earnings report? Analysts are predicting big numbers, with revenue expected to come in at $66.23 billion for the fiscal fourth quarter, a 68% increase from the same period a year ago. Earnings per share are expected to be 1.54, rising to 1.68 in the next quarter. Of course, there are also some potential risks to consider. NVIDIA's acquisition of Grok's assets, a company that specializes in AI inference, could be a game-changer for the company, but it also raises questions about competition from custom chip makers. And then there's the rollout of NVIDIA's next-generation rack-scale AI system, Vera Rubin, which is expected to be a major driver of growth for the company. As we move forward, it's clear that NVIDIA is going to be a key player in the development of AI. But what does this mean for investors? Should you be buying into the hype, or is it time to take a step back and reassess? We'll also be taking a closer look at the latest news and trends from the world of stocks and finance. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into a complex and contentious issue that has significant implications for global trade and the U.S. economy. The use of tariffs as a tool for trade policy has been a topic of debate, with some arguing it's a necessary measure to protect domestic industries, while others claim it's a misguided approach that can lead to unintended consequences. Recently, the U.S. Supreme Court ruled that certain tariffs imposed by the Trump administration were unlawful, sparking a new wave of discussion about the limits of executive power and the role of Congress in shaping trade policy. The ruling centered around the use of the International Emergency Economic Powers Act, or IEEPA, which grants the president broad authority to impose tariffs in response to national security threats. However, some argue that the administration's interpretation of the law was overly expansive and not supported by the legislative history or intent behind the statute. This debate highlights the tension between the executive branch's desire for flexibility in responding to emerging trade issues and the need for congressional oversight and accountability. Now, the administration is turning to another law, Section 22, as a potential basis for imposing new tariffs. But critics argue that this law is also being misinterpreted and that the tariffs would be unlawful. The issue is complex, with multiple factors at play, including the distinction between trade deficits and balance of payments deficits, as well as the limits of executive power under the Major Questions Doctrine. As we explore this story, it's essential to consider the potential consequences of these tariffs on U.S. businesses and consumers. the tariffs could impose significant costs, disrupt supply chains, and have far-reaching impacts on various industries. It's also important to recognize that the use of tariffs can have geopolitical implications, affecting relationships with trading partners and potentially leading to retaliatory measures. As the courts continue to grapple with these issues, it's crucial for policymakers to engage in a nuanced and informed discussion about the role of tariffs in trade policy. This includes considering alternative approaches, such as negotiating new trade agreements or providing targeted support to domestic industries. The implications of this story are far-reaching, and we'll be monitoring developments closely. For now, it's clear that the debate over tariffs and trade policy will continue to be a contentious and complex issue. Welcome back to the Riskwiser Zone. As we wrap up today's show, let's take a look at some exciting developments in the U.S. mortgage market. It seems that the average long-term mortgage rate has dipped below 6% for the first time since 2022, which could be a welcome relief for homebuyers as the spring season gets underway. Now, I know what you're thinking. What does this mean for the housing market? Well, according to Lisa Sturdivant, chief economist at Bright MLS, if rates stay below 6%, we can expect to see buyers and sellers getting back into the market. In fact, she predicts that this could be a barn burner of a spring home buying season. But before we get too excited, let's take a closer look at the numbers. The benchmark 30-year fixed-rate mortgage rate fell to 5.8% from 6.01% last week, which is certainly a positive trend. And with the 10-year Treasury yield down to 4.02%, it's likely that mortgage rates will continue to follow suit. Now, I'd like to shift gears and discuss some proposed changes to the regulatory capital framework for banks, which could have a significant impact on the mortgage market. The Fed is considering removing the requirement to deduct mortgage servicing assets from regulatory capital, while maintaining a 250% risk weight for these assets. This change could encourage bank participation in the mortgage servicing business and potentially reverse the trend of migration of mortgage activity to non-banks over the past 15 years. As James Kleiman, founder of the Mortgage Scoop, notes, "This stuff is quite complicated, but essentially, the Fed is weighing a plan to remove the rule that banks must deduct MSR assets from regulatory capital while maintaining a 250% risk weight for those assets. If adopted, these proposals could mark the beginning of a gradual rebalancing in housing finance, bringing more mortgage origination and servicing back inside the traditional banking system." So, what does this mean for investors? Well, it's essential to keep a close eye on these developments, as they could have significant implications for the housing market and the broader economy. As always, it's crucial to remain cautious and do your research before making any investment decisions. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.